We now move on to our next plenary, which is a thematic deep dive on climate smart agriculture. It's a very crucial discussion at the intersection of livelihood, innovation, and climate resilience. We all know that CSA represents a transformative opportunity for our agri-food systems because they help our smallholder farmers build resilience, enhance the soil health, and lower emissions. As we see that this sector is evolving, new investment pathways are emerging in agri-biotech, cold chain, post-harvest storage, precision agriculture, and soil carbon solutions. All of this is driving towards a more sustainable and productive agriculture system. To take us through this thematic deep dive more, I call upon now Suryanshu from CPI to show us how the different ecosystems, different technologies within this deep dive are coming across.
Thank you, Divya. Good afternoon, everyone. Today, I'll be presenting our analysis of the investment opportunities in climate-smart agriculture in India. Indian agriculture presents a compelling investment thesis shaped by the unique makeup. First, the sector is India's second highest GHG emitter, while simultaneously experiencing significant vulnerability to climate impacts. Moreover, as per India's LTLEDs, the burden of reducing GHG emission does not lie only on the farmers. Secondly, the sector's economic importance is substantial. It employs 45% of India's workforce, with 89% of our farmers being smallholders operating on fragmented land holdings with constrained access to finance. This structure has important implications for solution design and go-to-market strategies. Climate smart agriculture provides a comprehensive framework addressing these three interconnected objectives: ensuring food security, enabling adaptation to climate change, and reducing greenhouse gas emissions. As illustrated in this framework, achieving these objectives requires coordination across three foundational pillars: supportive policies, resilient institutions, and innovative financing mechanisms. The alignment of these elements creates conditions for scalable investment solution categories to emerge. To identify scalable investment opportunities, we developed a framework evaluating solutions across four critical dimensions: regional climate risks, socioeconomic realities, and financing constraints create specific scaling requirements for climate-smart agriculture solutions in Indian context. Our framework assesses potential investments through four parameters. First is the climate impact and the resource efficiency. Second is the farmer income enhancement potential. Third is the inclusivity and ease of adoption, which considers the upfront capital requirements, technical complexity, and the operational feasibility for smallholders. Fourth is the access to financing and policy support. Regarding the scope of our analysis, we covered upstream inputs through the post-harvest storage and preservation stage. We have excluded food processing, packaging, distribution to focus on interventions that have direct on-farm productivity and climate impact. This framework enabled us to distinguish between technologically interesting concepts and commercially viable, scalable investment opportunities. Applying this framework, we identified 5 investable solution categories that provide positive performance across our evaluation criteria. These categories are agri-biotech and biomaterials, precision and digital agtech, controlled environment agriculture, soil carbon capture, and post-harvest storage and preservation. These represent scalable technology and science-based solutions that function as enablers within the broader climate smart agriculture ecosystem. The investment data from Impact Investors Council provides validation for these categories. Between the last 3-year period we analyzed, approximately $335 million were deployed across 57 deals, with agri-biotech and precision and digital agtech leading the categories. Meanwhile, controlled environment agriculture and soil carbon capture categories, though nascent, as you can see from the graph, are seeing a lot of traction in the number of deals and also seeing a lot of interest from farmers, supported by a policy push from the government. The data indicates investor preference for solutions that combine climate impact with positive farmer economics and pathways to scale. Based on our analysis and stakeholder consultations, several insights emerged from investment decision making. Regarding policy and alignment and market dynamics, the government initiatives in agriculture digitization and climate smart farming create tangible demand signals. Companies aligned with these policy priorities benefit from reduced market development risk and potential access to co-financing structures. Moving on to the farmer-first models that deliver strong climate co-benefits demonstrate superior scaling characteristics compared to technology-centric approaches with complex adoption requirements. Looking at the integrated value propositions, companies that bundle inputs, advisory services, market access, and financing create more resilient business models with stronger customer relationships. Similarly, hardware-software integrated solutions tend to secure larger funding rounds and repeated investor backing. Finally, on the emerging opportunities, soil carbon capture and controlled environment agriculture are gaining investor attention despite smaller initial transaction sizes. Geographical context and smallholder appropriate financing models remain critical enabling factors for achieving scale. Deep tech solutions addressing systematic agriculture changes continue to command premium valuations in the market. Thank you.
Thank you, Sudhanshu, for this insightful deep dive around the investment frameworks and the solution categories. I now call upon Aishwarya, Senior Manager at Samhodhi, to take us through the COVID-19 Response Fund, through the agri transition in India.
Thank you, IIC and Rabo Foundation for inviting us to share reflections from the COVID-19 Response Fund for Agri Transition in India. I'd like to begin with my experience at an FPO in Tamil Nadu. Just to paint a picture, when I entered the facility, it had multiple processing facilities, it had an in-house warehouse, a thriving farmers market supported by NABARD, and a retail store which had FPO branded products. The FPO also has 6,000 members and 5,700 of them are women smallholder farmers. Now this FPO during the pandemic faced losses to the tune of 600 metric ton of tur dals, and this heightened the risk perception of financiers, which means there was a challenge in terms of accessing working capital finance. As with other MSMEs during that time, two cases or scenarios emerged. One being that there was stretched working capital requirement, and second, the requirement for enhanced debt requirement, basically focusing on enterprises that focus on viable and sustainable farming practices for smallholder agriculture. Now, during this time, what happened is that in 2024, this FPO wanted access to working capital finance, and through the COVID-19 Response Fund, they were able to access capital which not only helped them to recover from past losses, but also meet their largest ever tur dal procurement. Now, this is not just an exception. The COVID-19 Response Fund has supported about 83 MSMEs, has supported 83 MSMEs. Let me just give you a quick overview of what the Response Fund is structured as. It is a $55 million fund with a pari passu guarantee, which means 50% of the risk is shared by the lenders. It also has a technical assistance program for both lenders and the borrowers. And the fund is targeted at four sectors, that is FPO, renewable energy, agtech, and food loss. The key aim of this structure is to address the gap of liquidity gap for these four asset classes that help small and marginal farmers to access viable and sustainable agri-transition assets. Now, between 2022 and 2024, the fund has been able to unlock $17.3 million of credit over 83 MSMEs, and it has been able to reach 6,45,000 farmers, much higher than the target of 2 lakh that the fund was wanting to achieve. Other than that, so far the claims that has been raised is to the tune of 1.05 million US dollars, which is close to around 6%. We also did a social return on investment analysis for this fund. This was done by aggregating the value generated at different impact metrics. And so what we observe is that with a marginal change or shift in the perception of lenders, there's a much higher impact that can be created at the MSME or the enterprise level as well as the farmers level. And aggregating all of this, we get a social return on investment of 8.77. And when you compare it with the European Investment Fund, which also supported MSMEs across 3 nations, the SROI was between 2 and 6. Now, if you compare the SROI with CSR agriculture programs, it's almost comparable. And this was around between 6 and 9, what we've observed in India. So the conclusion is that a catalytic fund like this can, change the perception of the lenders, and that could have a much larger impact. As part of next steps, we are also looking to do a benchmarking exercise of blended finance models in India and globally. And I would be happy to engage with fellow peers here to have cross-learnings on, what is working and what is not working. Thanks so much.
Thank you, Aishwarya, for these interesting learnings from the fund. For the panel discussion, I now call upon this, Rahim Roy, Partner Omnivore, Neha Khanna, Associate Director CPI, Emmanuel Murray, Investment Director Caspian, Rajkumar, Head of Investments at Nivaka Social Business Fund. And to steer this insightful discussion, please join me in welcoming a moderator, Hari Rajgopal, Consultant at Rabo Foundation. Over to you, Hari.
Good afternoon, ladies and gentlemen. I think we're in the most difficult slot of the day, 3:30 to 4:30. So maybe as a request to everybody, could I request you all to get up once and then sit down once again? Just to be sure that we have a live audience in front of us. We promise not to bore you too much. We promise it's about 3:45. We want to get to Q&A by 4:35. And 4:30, which is what the time which has been given to us, about 47 minutes. We have a ticker, so we won't bore you too much. We have 4 stellar panelists here. And I think I picked this up from the previous panel. Maybe we'll get the self-promotion done with in a quick 2 minutes for everybody, because we are all expected to say something about our organizations by those who sent us here to speak. So of course, and maybe I'll start. My name is Hari. I work for Rabo Foundation. We're the foundation of Rabo Bank. And we work with smallholder agriculture in 24 countries, India being one of the very large geographies for us. And most of our work is around supporting financial institutions to work in underserved, perceived high-risk sectors, such as farmers, FPOs, upstream agriculture. And as we say agriculture, we also have to say climate, because agriculture is both contributing to the problems of climate change and is also getting affected by climate change in turn, and more importantly, the livelihoods of millions. And thanks to the CPI team presentation, where I think it was clearly put on how income stabilization has become a clear imperative of climate change. Also, improve productivity, improving the resilience of what we grow, and of course, looking at soil quality as some of the areas. That's what we do. And then, of course, what I'll request all our panelists is probably to give a little brief about what they do. Of course, CPI, perhaps you did a presentation, but we do that, and then we'll get to our questions to deeper dive into this. Of course, on the program which Sambodhi made a presentation on, that's one of the large programs done by Rabo Foundation, a $55 million program along with Shell, IKEA, and of course, facilitated by USDFC, and is the large programs of blended finance targeting sustainable agriculture. So that's the results and the review of what you saw in the presentation made by Aishwarya. So, Emmanuel, sir, with you.
I'm Emmanuel from Caspian Impact. We are an equity investor, and the fund that is active at this moment is investing into agriculture. And agriculture cannot be separated from the impact of climate change, and so therefore these are interrelated subjects, and we're looking at opportunities to invest into climate tech companies at the moment. So that's about what we are. Pramod here was sitting from Black Soil, which was a part of Caspian Debt till some time back. So we have quite a bit of experience from our debt company also, which feeds into our knowledge on this space. Thanks.
Neha.
So I think most of you are familiar with CPI's work, but for the broader context, we work on different thematics, including power sector, industrial decarbonization, agriculture adaptation, basically everything related to mitigation, adaptation, and now with a lot of focus on gender, livelihoods, and health as well. And we support it both through research and advisory services.
Right.
I'm Reham Roy from Omnivore. We're a venture capital fund focused on agriculture, food systems, and the rural economy. We've been around for, I think, about 15 years now, and we have invested across 3 funds and continue to do so. Again, like many have pointed out, we see no distinction between investing in the future of agriculture and in the future of climate-smart thoughts, because effectively they all meet and converge at some point. So that's us.
Sir.
Hi, my name is Raj. I represent Navaka Social Business Fund, and we are a patient debt capital provider to early stage SMEs working at intersection of climate, livelihood in the sectors like agriculture, water, sanitation, waste management. Yeah.
Thank you. I think first I would say first let's look at classifying sustainable agriculture into say 3 buckets. First is say subsectors that are already in our view, in the considered view of the panelists, considered investable, bankable, lendable from a more mature perspective. Sectors that are not investable at all or very, very nascent and are literally a moonshot. And the third is somewhere in the middle. I would say if you could first classify in your view and say 30 seconds each, what do you think are sectors that are investable or not, and perhaps double click after that on why do we think some sectors are doing better than others, or are these the challenges which are policy challenges, are they just simply demand driven challenges, or are they financing challenges that hey, there is a demand, there is a supplier, but the financing is a problem. So perhaps I want to start with you, Rahim. and followed by you, Emmanuel, sir, on that.
I think the great challenge with highly investable sectors is once it's highly investable, it's no longer highly investable. So the 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 trick is to find it just before it becomes highly investable, before anyone else does, and immediately after that we have to find the next highly investable sector. But jokes aside, I think there are challenges, of course, when we look at things that are very nascent, when we look at things that are emerging, and we look at things that are highly established. I think different investors play different roles here. Growth investors and the world of private equity definitely plays a massive role in scaling ideas that have been established and proven to be sustainable and profitable and impactful. But I think perhaps where venture capital plays a role is in that middle space where we're talking about things that are showing indications of viability, of sustainability, of profitability that need to be nurtured and backed so that they can prove to the larger sources of capital that they are worthy of those large tickets that can allow them to scale. I think perhaps the victim here in many ways, and it's ironic because we depend on it for deal flow, are those nascent ideas and those nascent solutions. And in many ways, I think the current structure of investments in India, the typical fund life of, let's say, an 8+2 fund in India, not just in India, from irrespective of the source of capital, is not very friendly to nurturing and supporting nascent technologies. So we're often playing this relay race where 5 or 6 like-minded people need to come together and sort of hand off something that is not proven, not established, not a sure shot to each other before it can emerge as something that is worthy of serious investment. And I would say that's perhaps where this system is most broken, in our inability to be patient with deep tech and our inability to be patient with emerging tech.
And which do you think sectors have done well? Friends, and I'm saying also benefit of the last 15 years in your journey as Omnivore, which do you think has moved a little further in saying that, hey, today we think this is commercially viable to where it was when we put in the money?
So I think that's a moving target, and I'm not choosing a safe answer. The truth is that no one entity determines success. Unless you're a pre-series A to IPO, pre-IPO investor, you don't really have the ability to dictate how things will flow, how capital flows. So a whole set of institutions need to validate each other's thought processes for something to work. I would say more recently we've seen manufacturing receive that sort of uptake, whether it's using post-harvest technology taken really to its logical conclusion, where we're talking about value addition, not just at the farm gate, but into the most final version of a product. We're seeing a lot of traction there. There seems to be global recognition of fundamental businesses that can produce things and be sustainable in that sense. But I think it's hard to pinpoint because these targets are moving from theme to theme, from bubble to bubble.
Absolutely. Emmanuel, you are obviously working at very early stage investments as well. And with vast experience, perhaps you could also weigh in on this question.
Okay, so just building on what Rahim has said, biotech is one space where there's a lot more to be done, developing new varieties which are climate resistance, building biologicals that address these problems, precision agriculture, where you're able to give information in time to be able to deal with changes in climate, protected agriculture, which kind of becomes indifferent to climate change. All these are solutions that are equally important and need to be addressed and are at different stages of business. But the major part of climate smart agriculture is actually at the farmer level, where a majority of the solutions involve natural resource management of both soil, water, and other resources, which generally are not commercially fundable, but still they are the vital pieces in this whole model that still need to be done for climate smart agriculture to be successful. And unless these are combined, mere offering solutions which are commercial will not solve the problem.
Neha, coming to you, since you are observing these sectors, what do you think differentiates or has differentiated in the last decade plus the emergence of entities into these sectors? Are these demand side challenges, these supply side challenges, are these finance side challenges? Maybe you weigh in on that.
Okay. So, coming in from an outsider's perspective, since we don't finance, but I think what we've seen, one, I think what Emmanuel said hits the nail on the head pretty well, that the farm activities actually don't get the financing. They need the finances, right? If you really look at it, 85%, 84% are small landholder farmers. They're not creditworthy by the traditional sense of being creditworthy. And I say that keeping in mind that actually, even with schemes, even with pushes like a Kisan credit card, even with priority sector lending, getting money on the ground is a challenge. Second challenge, which we have seen sort of being worked upon, is that the value chain wasn't in limelight enough. It's not that the value chain didn't exist, but focus on cooling, focus on insurance, focus on affordable insurance. Let me add the word affordable in front of every single item that I say. Affordable insurance, affordable cooling technologies, affordable cropping mechanisms, storage, warehousing. What has started happening is, and over the last decade or so, there has been focuses or pushes either through policy or through patient capital coming in and saying, yes, some of these sectors are ready for investment. If we look at the total finance flows, we found that about 90% of private finance was commercial banks, only because of priority sector lending. And I'm being very upfront about that, only because of priority sector lending.
Absolutely.
And that is misleading, because the minute you start the conversation with saying 90% private sector finance, everyone says, see, agri gets finance. Where is agri not getting finance? But keep that private sector, the scheduled commercial banks aside, because that's a black hole in itself. Where is the financing coming from? Who's financing? How many debt and equity players are actually saying, okay, let's invest in innovative agri? So the changes are that, yes, there's been a push. Yes, there are policies which exist, but the challenges that still remain are that the changes actually need to also start trickling down or being made for the uniqueness that India has. And somebody in the beginning actually mentioned this, that a lot of what has worked for the West will not work for India. You have women who are managing farms which are not in their names. You can't give them credit. Banks cannot give them credit. NBFCs cannot give them credit. So how do you solve those challenges? So challenges exist. There's been progress, but challenges exist.
I think you make a very important point on the challenges of India being different from the challenges of the West. I think we also now probably need to take a step into, I think, a point that Neha touched on how do we take financing innovations and innovative financing structures, both. How do we take that hand in hand ahead? And here, I'd like to bring Raj into the conversation. Now, wearing your, I would say, multiple hats and your vast experience, what kind of innovative financial structures do you think are feasible for the Indian context?
Yeah. So I think at least in climate smart agriculture, we have a problem of not just financing. We have to finance both, top down and bottom up. And by bottom up, I means we need to finance farmers who are trying to adopt these technologies, whether it's drip irrigation, whether it's solar water pumps, be it biodigester or DSR, direct seeded rice machine, or any other piece. And only financing can become an enabler for farmer to adopt. Obviously, there are many other factors for farmers to adopt this technology. And at the same time, we need to do top-down financing, because unless you finance these innovators who are working on these technology, and as Emmanuel mentioned that biofertilizer is one, say, if you don't finance biofertilizer companies, farmer won't have access to these. So no matter what, if even farmer is getting finance, they won't be able to adopt to these, climate smart technologies. So you need to finance those innovators, be it SMEs or intermediaries, and when these innovators get finance, they can achieve at certain level of economies of scale, where they can bring probably prices to a certain level where these prices can compete with the traditional technologies which has been working on. So that is one kind of financing approach which is required, top down and bottom up. Second is obviously the patient capital, because when you invest these innovators or when you invest these farmers, there is a certain level of gestation period required when investing in these technologies or these adaptation technologies. Third is along with these two, third one is needed, because some of these technologies are still at nascent stage where they have not achieved economies of scale or they have not achieved a large adoption. So you need some kind of credit guarantees. That's where some of the credit guarantee funds comes in, and one of them I am advising Agri-3 fund. So there also we have taken both the approach. With help of a bank, we are financing farmer through MFI program to help farmer access to finance to adopt to these technologies. At the same time, financing all these innovators, be it a solar water pump manufacturer, be it a biofertilizer company, be it a spices company or others. So I think these are 2 or 3 ways we can kind of finance the whole gamut of stakeholder lying across the spectrum.
Thank you, sir. Emmanuel, sir, in terms of your own work with Caspian, but also the NABARD system, where do you think innovative financial structures, what structures work, what don't?
So we can break this up basically into 2 parts. One is, of course, the enterprise financing. So financing things like biotech, where there's a lot of investment that goes into research, is a long-term game. So the ability of patient capital to support that is important. Again, some of these solutions are capital intensive, cold storages and the like. So they require investment which is a blend of both debt and equity. And these also to a certain extent are taken care of, but still I think the need is much larger. Coming to the other side, the end users of these solutions and technologies, debt as a solution has to always look at the revenue streams as well as the predictability of those revenues and the capability of those cash flows to be able to service this kind of technology, as well as factor in, again, externalities or risks that come with adopting these technologies. So all those have to be built in. The affordability is one aspect of it. The capital availability with the farmer to be able to receive this. I think the myth that the Indian farmer is resistant to new technology is largely a myth. They are open to looking at new and innovative. They've absorbed in a large way, in many technologies have been absorbed with very little of government or other support itself. So the opportunity to send or to absorb these technologies is very large. But we need to make it affordable. We need to de-risk it in ways possible, as well as structure it in a way that matches with the cash flows. So there are natural events, calamities that happen. There are also market cycles. So every 3rd year the price crashes. Now these are things that the farmers have inbuilt, in a 5 to 6 year period. 2 years will be bad, 3 years will be good. And you even it out, it happens. But for a financial institution, an NPA is a ticking time bomb. His rating is going to go down. He can't afford to keep it on the books.
Absolutely.
So how do we absorb that? So how do we insulate that for a lender and make the comfort? And then this whole issue of farm finance being a political risk is another overstated hype that is there, which again I think needs to be kind of realistically looked at.
Debt. I think one observation is that I would say more of the subsectors have become lendable in terms of the product market fit unit economics. And I'll say this a little more confidently in 2025 than we did in 2016 or 17. And the fact that we're having this forum with sufficient number of both innovators, demand side, supply side entities is also proof of that. I would say there's also been some decent work around de-risking. I think Raj pointed out what the Agri-3 fund has done and what say very dedicated a fund like Novaka Social Business has done in terms of looking at waste and circularity, but also the work of the Rabo Foundation in de-risking various kind of NBFCs and even some banks in lending to various subsectors of the sustainable agriculture space. I think the DFC program is also one example. I think one key thing is that given that the subsector hasn't settled, nobody really knows the loan loss. And there is very difficult, unlike say microfinance is a good example, that a net NPA of or par 90 plus of 5% is good, is bad, is ugly. That's the view of the sector. Unfortunately, these asset classes are not settled enough for their view to be taken. So how much guarantee is too much? I see Anant in the room. They will tell you, and you can catch him offline that, Wilgrow has tried numerous type of, guarantee structures. And they offer, almost like a Santa Claus deal on to lenders that you take a 50% guarantee or a 70% guarantee. But the truth is nobody knows how much guarantee is required often in some of these new sectors. And I think one point which is critical is the cost of funding. And I think that's something which none of us here at this table have an answer to, because unless the lending institution has access to sufficient low-cost capital, especially for the agri sector, given the nature of margins of the businesses in this sector, you can't really make the access expand beyond where it's already expanding. And this is, and as Emmanuel said, farmers are ready to absorb innovations. The interest rate myth is also, I would say, largely a myth, but it still has to be reasonable. Even if it is not, this holy cow kind of single-digit interest rates, but it still has to be reasonable, commensurate with the nature of risk and margin. So I think that's one thing which I'd like to add to the discussion. Maybe I would want to come to you, Vaneha, and on this. That, for example, let's talk about convergence. And let's talk about catalytic capital. And I want to come to Neha and then Raham in that order. That is convergence even feasible? That there are diverse public finance schemes, there are yojanas, and I think you did touch on priority sector lending being one example. But how do we meet this scale-up challenge in terms of going beyond very nice pilots that are always successful to large-scale executable programs? And how do you meet that demand for capital?
Honestly, I'm not convinced that there is a one-size-fits-all solution on this. For multiple reasons. One, the government did try to do something on insurance front, where they said we will backstop, get private insurance players to offer insurance for agriculture. Had very mixed results. Not to say the scheme was bad, but what he mentioned that the inability to actually predict the losses currently due to extreme weather events does create a challenge, because just like finance, insurance has to be profitable. An insurance firm has to have a profitability matrix in mind. Can there be convergence? Maybe not, but can public finance be used to leverage private? And I know this is a very overused term, but for the context it does work. You have a lot of push towards agriculture because And I actually think because agri is a political issue, there is a lot of capital that ends up going because it is something that you know will get the interest, as controversial as that may sound. And because you have that push, you have private finance sort of saying, okay, certain areas we can take a leap of faith in. That's why this panel exists, like you mentioned. The other area where actually I think, and this isn't spoken about enough, is actually data. Data exists, it's disaggregate. I know there are talks, there has been focus on an agri stack, but there are challenges there still. But can we actually reduce information asymmetry using this PPP or this convergence where you're able to ensure data privacy while making the critical or the relevant data available to select set of players or the select set of stakeholders? And the third area where you can have convergence happen is less on the finance part, but more on the guarantee structuring part, where public finance comes as a de-risker through a guarantee mechanism or through an insurance, through a subsidized insurance mechanism. And the government has already given feelers of a national insurance program, but in agriculture, if you can actually get support to both the financiers and the entrepreneurs, the end user will get the benefit.
Rahim, I want to come to you, touch on this topic, but also probably answer a point on, whether equity funds, would it be feasible to have a catalytic capital pocket for supporting, the diffusion of innovation and supporting sustainable agriculture? So 2 points to you.
So I think just stepping back, wholeheartedly agree with what Emmanuel sir was talking about. But I think, and if I just pick up on a statement that Neha made about taking that leap of faith, I think the only people who actually can take, the only source of capital that can take a leap of faith is public capital. And the reason is because they're not answerable to anyone. Now, before everyone jumps on me, I know they're answerable to us, but in reality, they're not answerable to anyone in the short term. And to come to your question, I think the point on private capital is not just answerable to very often a large number of people, they are answerable to a large number of people in a very short duration of time. So, yes. I mean, not to pass the buck on, but the truth is that when LPs make these sort of financial tools available to GPs will make it available to the companies that are then working with solutions on the ground. But I would say that in my limited experience, and I'd love to get people like Emmanuel sir who have seen this a lot more to weigh in. I would say that when we have seen innovative blended finance being pushed in other continents, but not necessarily as much in South Asia. And the impact of that is reflective in the products that can be passed down. I could be wrong, but this seems to be the trend that I'm seeing, where each source of capital reflects its own source of capital in terms of its intent and its ability to deliver.
Raj, I want to come to you on this, and touching on what Rahim just said, that there are examples of such innovations outside India. Perhaps you want to touch on a few success stories.
Yeah. So there's one deal, Agri-3 fund kind of guaranteed. It is called Responsible Commodities Facility, where a large supermarket chain came together with a couple of funders, and they have developed 200 soya farms, where close to 240,000 tons of soya is being sourced without deforestation. And those farmers who are kind of managing these soya farms are provided low cost funding access based on the certain criteria which this particular facility has set up on the deforestation. So that helped this particular supermarket chain to source soya without leading to deforestation, while investor also could invest their capital in certain assets which were hard to find. So I think what the point coming out of this particular example is that the collaboration between different partners can become a key, where a funder, guarantor, off-take partners came together and designed something which was suiting all their need and also working well for the farmers who were kind of the end beneficiary. So I think these kind of models can be explored here also.
And do you think, just as a follow on, do you think there is some replicability in India where you see and from a deal flow?
Yeah,
So
so replicability may not be exact. We may tweak it a bit. Like instead of funding soya farm, say 200 soya farm, we can find a FPO focused on a particular commodity or particular region, and then or some FPC or collectives focused on a particular region or particular commodity, then bring an off-take partner, and obviously the guarantor, patient capital, and some of philanthropic capital, which probably can help reducing the cost of capital for end farmers. So that can be done, so I know there are a couple of companies, I think we have had discussion around it and they are working on it, so hopefully such examples can come out.
I think we need some of these transactions to succeed, and perhaps, and Emmanuel sir, maybe you should also weigh in on this.
Yeah, so we have seen some very successful models. Climate smart agriculture has to be A, area based, B, community based. Now, if these two are missing, just one farmer in one village trying to do CSA is meaningless. And to do these, there have been a large number of success stories in the country, and with working with corporates. So the program money comes from grant funding, the operating cost comes from the CSR of the corporate, and the community implements these projects. And why we need a combination of these is because the land belongs to multiple owners. So there's 25% of the land that's being cultivated. There's another 20% which is held by NRIs who have migrated to the US long ago but still hold land. There's panchayat land which is there. There's forest land which is there. And unless all of these are addressed in totality, CSA is not going to work. So being able to plan, design, implement the whole program requires not just community to be working together, but able to address problems. Because, if you don't address the upper reaches which are in the hands of the government, the lower reaches cannot be treated in any way because the damage is happening from the top. So we have to deal with public lands which nobody owns, but still needs capital. And how it has been designed is to, the non-monetary element of the program is always contributed by the community through simple things like local resources. You can use local stones, you can use local soil, you can use labor during the off-agricultural season. The community itself is willing to contribute. And with all these, you can create lasting assets that build sustainable agriculture on a long-term basis. Unfortunately, sustainable agriculture, the positive side of it takes 5 years to be evident. You won't see it next year. You will see that there is water in this stream flowing for 6 months, 3 years after you actually start working on it. The ability to be patient and deal with these. And the positive side of these in terms of reduced migration, improved productivity, diversified economic activities, increase in the value of the land that people own, all these are economic positives that are largely unquantified. And ultimately, making these farmers bankable also. If you just go and see the deposit balances in some of the areas where this kind of projects have done, you will see that there's been an accumulation of deposits. The lendability of farmers has improved. And all these lead to prosperity. And there are documented reports on these of how many millionaires came out of a sustained institutional and societal collaborative effort that has taken place. So I would say there's a lot of encouraging information in our own country around this space.
Thank you, sir. Maybe the last round of questions, and maybe I'll pose this to everybody, that if you were to think that what are the one or two things that are a necessary condition for sustainable agriculture to become mainstream, and by mainstream I mean mainstream, bankable, successful, what would it be? And I would say 1 or 2 points to each person. And maybe Neha, we start with you.
Capacity building for all stakeholders. This panel understands CSA, understands climate resilient, and understands sustainable. We've used 3 terms in this panel itself for a topic.
Yes.
The number of people who understand the difference between all 3, or the number of financiers who can actually, so you're expecting a farmer to talk language A, a financier to talk language B, the government to talk language C. There is a lot of capacity building that needs to be done. What Emmanuel sir just mentioned, how many people actually know that? How much of awareness is there that yes, this is something that if you wait for 5 years or 3 years or 4 years, the success will come. It's a handful of people. So I would say capacity building is one. And the second is more transparency around where investments are actually going and how they're impacting. If we can actually get that in the public, in my view, that would help change a lot of what he was mentioning, that if the LPs don't have that, the GPs can't have it. Okay. If you give them a reason to have that as a motive, yeah.
Raj, maybe you come next.
Yeah, sure. I think for me it would be, and I think many of our panelists have also echoed the same, that patient capital, because these technologies or these changes which we are proposing as a part of climate or sustainable agriculture requires, takes time. And as Emmanuel sir also mentioned that, you need 3 or 4 years time to even, evaluate the evidence which are coming out. So patient capital would be the one. And second, again, financing all, or making the finance and technology accessible to all the stakeholders, including top-down approach, bottom-up approach, building digital infrastructure, so that these financing or these, the outcome which are coming can be better tracked, reported to general public and investors, which can probably help in raising these kind of funding.
Rahim.
I would say political will, and I say that for a very specific reason. When we're talking about something as divisive as climate, and when we're talking about 10, 15, 20, 30, 50-year strategies, we need consistency. And just to share an anecdote, which I found particularly funny, I don't think the people I'm talking about found it funny. We were in the US, and we had a room full of GPs that have taken a low-risk approach by making most of their climate-smart investments in the US. It was pre-Trump. And suddenly, they had a 5% South Asia exposure because risky geography to invest in. So we're saying, how are you feeling about that right now? This is just an example of this super stable, what we consider risk-free and what we consider risky can get turned on its head. And if we're operating as investors within a space, and we're merely the catalysts here. There are entrepreneurs working within this space. Surely we need at least a couple of decades of consistent policy to undo a couple of centuries of misadventure.
Absolutely. Last year to you, Emmanuel sir.
Yeah, we do not have the luxury of time, and that's why we have to do this very quickly. So engaging with the farmer-centric approach towards designing solution would be a key factor that we need to do to solve this problem.
Well, I would say, as in my own view, I would say the availability of low cost of debt to wholesalers who provide debt to the agri sector. I think that is probably the most definitive pointer that this sector needs, because then a lot more technologies would become feasible, a lot more loss given defaults will become possible for people to digest, because the one monkey that nobody is able to control right now is the cost of debt to the lender itself. So probably I think if I were to choose one, I will choose that. And of course, I'll probably go with Neha on the capacity building for all stakeholders, not just one category of that. With that, I think we come to the end of the discussion itself. But I do see we have about 3 minutes for questions. So any questions in the house, please?
Hi, I'm Rohit. Excellent panel, I would say. Not a question, but a reflection on the presentation that was just before this panel. I believe part of the reason the climate smart agriculture is not able to take the kind of strides in the market is partially because there is a huge information asymmetry from the market pricing side for climate resilient value chains versus the production ability of the farmer, right? So you can work with the farmers who can basically produce the climate resilient crops, but until or unless the profitability of that particular production operation does not come into play, it is not going to be scaling up as we expect in this room. Secondly, and of course, I think this was also reflected in one of the social ROIs, the indicators that were reflecting, right? So you think about impact, you think about all other factors, everybody understands it. It's just that till the time the risk returns and the profitability of the end producers, the smallholder farmers, that will not come into play. That is going to be a big bottleneck for us. The second thing I believe is, again, my personal perception of the entire ecosystem is there is enough capital available for de-risking some of these operations. And the example that was provided in the study by Rabo Foundation, that's an excellent one. The gap that I see is that the practicing financial institutions who can deploy that capital to build a sustaining portfolio with the climate smart agriculture at its core, I think there is a gap there, and there needs to be some more push in order to bring more FIs who can not only build this portfolio but generate returns for the investors, so that this entire chain reaction of investments, returns, everything continues.
Thank you. We definitely need this tribe.
Could you
of institutions to
identify yourself, please?
Emmanuel, this is Rohit Danda.
I think, okay. We also then go to the lady in the back. Yeah.
Hello everybody, I'm Iti from Erda Illumin, and I really loved each one of your inputs. Here I just was a little surprised that nobody mentioned about the revenue that can come in from carbon credits, because for us, we are implementing projects, we are issuing credits, and we are working out sales. And I was there in the Climate Week in New York. And trust me on this, there is a lot of demand, and a lot of companies are willing to get involved and bring in the finance in these agriculture projects, both regenerative projects, where we are talking about SOC enhancement, and the alternate wet and drying project in the rice cultivation. Thank you.
Rahim, do you want to take it as an investor in a carbon platform, or should I take it?
No, you please.
Well, I think the short answer is, well, one thinks there is revenue, but we think it's a cherry on a cake and not the cake itself. because the revenue, what I think from a debt perspective especially, the predictability and recurring revenue, the jury has not settled on it. Everybody is looking at it with some interest. And our friend here has also made an investment in a leading carbon developer. But I think, are we certain of where these revenues will come? Who are the buyers? What are the prices? Will these buyers remain in the market with geopolitical risk? You know, these are all questions to be answered, but it's a space that a lot of people are watching out for, and I think would be happy to contribute to if it does meet the, because everybody would like to support the carbon sector, but certainly it has to meet the other criteria from a credit perspective.
Hi.
This is the last question.
Yeah. I myself, Jay Shankar. I represent Grant Thornton Bharat, the FS consultancy team. Specifically, this is not a question. A small suggestion, since we have like-minded people in this forum. This is about co-lending. And co-lending today is around 1 lakh crore book, as you all know. And 65% of it is contributed by personal loan space. The 10% which the speaker Neha from Climate CPI was talking about, the 10% book which ideally need to be built under PSL mandate. The banks have been working on that for a long time. Now under co-lending guideline, which was earlier issued and now reissued this year, still there is a big lacune due to which the co-lending has not penetrated this 10%. And that lacune is that co-lending doesn't cover small-term, short-term loans. Now, you look at all the NBFCs who have been actively involved in last mile loan facility for agriculture space. Since STL is not covered, there is no scope of co-lending with NBFCs by banks for building an individual farmer loan portfolio.
That's right.
So this is a big piece which is missing. A small tweak in the circular, if it can happen, telling that at least climate smart agriculture loans will be, even if it is a short-term loan, will be covered under co-lending. It can automatically, without any effort, it can automatically plug in a lot of money, which is like 10% of 275 lakh crore total lending book of India, that comes to 27 lakh crore. So that is the impact we are seeing by a small tweak in the entire circular.
No, you are absolutely right. I'll say there are 2 tweaks that are needed, not one. And Jaishankar, you have done significant work on co-lending. I fully concur with what you are saying. One is the co-lending, we need to refine the circular to make it a little operationally easier. Some tweaks have happened, but some haven't. This whole aversion to revolving credit facilities, not being part of securitization, not being part of co-lending, is something one needs to revisit. I don't know it's easier said than done, so I think that the jury is still out. The second tweak is, if PSL status can be provided to wholesale lending to NBFCs who have a given percentage of their book in agriculture, that itself will open the floodgates of bank credit to NBFCs, just like how it is done for the MFIs. That's the second tweak the circular needs. But yeah, I think we are completely out of time. I see the organizers looking at me. So thank you, my dear panelists, for an invigorating panel and for sharing your thoughts. And thank you to the audience for listening in.
And the other panelists for this very great discussion. I think we all need a short break, so we can break now for a coffee break, and we'll reconvene in next 15 minutes for the last plenary session of the day. Thank you.